Let's bring in Julia Lee. She's joining us from Bell Direct. Julia, welcome to the conversation. Good to see you. Well, if it weren't for those darn financials and banks, and you could throw in the healthcare names as well, it would have been a cracker of a session. It was pretty positive, though, by the end.
Still wasn't bad. If we have a look at the close, it's the best close we've seen for the Aussie share market in around about 4 weeks. So we certainly have been improving. It's just by these tiny increments, so it doesn't feel very bullish. But in fact, if you have a look at the month of April, every single month has been a gain, and that compares to March, where almost every single week was actually a loss. In fact, only 1 week in March we saw the market gaining ground. So altogether, the market is feeling good here. It is gaining. If we have a look at what it is that's driving the market, in the month to date, it's really the energy and the material space. So those resource companies have been doing well, and of course are in focus as they release their quarterly updates. On the flip side, as you can probably guess, it's been the financials that has been dragging the market to, I guess, more blue sky performances, and the utility space as well. But look, given that backdrop, today on the market, we did see some of those stocks that have been in an upgrade cycle continue to gain ground. And in fact, we saw a 52-week high coming through for GWA, which makes plumbing equipment, as well as for Xero, which is the service as a software accounting software firm, and Select Harvest. But then on the flip side, some of those companies that have had bad news continue to see losses in terms of their share price. So we saw 52-week lows not only for Blue Sky once again, but also Village Roadshow, which not long ago came out with a profit downgrade, and also GetSwift. So I guess it just it shows what kind of market that we're in, that the good news and the momentum really drive stocks higher, but if you're dragged down by the bad, that can take you much lower as well.
Hey Julia, it's Ben. Hope you're well.
Ben.
I was just going back to the financials. An area that's really sort of interested me is the fund managers. They're totally out of favour. Perpetual, Platinum, Magellan, BT, Janus Henderson. There's a couple of issues with some of them. Have you got a view here? Because markets generally are trending higher, as you said again. You'd expect these stocks to be bouncing pretty hard, and they're all on their sort of close to their year lows. Look good value. What's your view there?
Ben, it's a good question, and I love looking at things that are cyclical and love looking at trends. And I think when it comes to these fund managers, I'm really picking up on a structural change in terms of the market. It's about some of the low-cost ways of getting into the market at the moment, which are exchange-traded funds as well as boutique fund managers. So I think for investors, it's coming either to low-cost or performance. And some of these big fund managers that have dominated in past decades, which was sort of middle of the road there, that were active, that charged very active fees, but didn't quite have the performance or the outperformance, that's starting to, I guess, lose investors' interest. So I think we're seeing a shift in terms of investors' taste, that they're either going down the low-cost path or the high-performance path through boutique fund managers. And some of these big giants, which are sort of middle of the road in terms of both price as well as performance, they just continue to languor a little bit here. And I don't think it's just an Australian trend. I think we're seeing this globally. And I think it's also reflected in some of the fees that we're seeing some of those active fund managers charging, and they're obviously coming down. So when you're investing into a funds management firm, you're obviously looking at the fees that are charged, but you're looking at the performance fees as well. And certainly the management expense ratios are coming right down, and the performance fees as well. If you have a look at the first quarter of the year, it wasn't that great. So look, I think it's a hit to sentiment and a combination of the structural changes in the market as well.
Ben, I'd like to know if that sort of makes sense to you, because it sounds as if you've been running a ruler over these guys, thinking, look, everything has a price. I mean, if you had to pick a fund manager in that space, one of those listed fund managers, is there one in particular that you would gravitate towards?
I think Julia makes a lot of sense there. We've seen the rise of companies like Hub24 and Praemium.
Doing very well right now.
Doing really well. So there is a move there. But I do think these stocks look out of favour, and yes, maybe there is a longer-term structural decline happening, but I think the market's probably got a bit ahead of itself in terms of how quickly that will happen. And the one I'd probably pick out is Challenger at the moment, because I think the annuities market is one that I think is almost guaranteed to keep growing as we, our population continues to age. Governments are actively trying to push us into having annuities, and they've really looked like they might have cracked the Japanese market, which could be a huge opportunity for them. So that's one that's dropped from $14 to about $11 in the last few months. They had a great result in February. It's very well managed, and probably the other one that's sort of piquing my interest is Magellan, which the thing I find interesting there is the acquisition they made of Airlie Funds Management. They announced in February, which is John Sevior and Matt Williams, and it really will give them an Australian funds management business to grow. They've got a great name still here in the community here, and that business could go from a $6 billion fund business to 20, I reckon, pretty quickly. So, I still think that there is growth for those two. Perpetual, I think, Julia, I think is bang on there. It's getting harder for them. They just dominate a small market, and it's either cut your fees or, it's hard to grow. So, but platinum's fallen from over $8 to $5.40. It's a big drop. It looks interesting to me.
I'm curious. I mean, just going to some of the broader themes today, talking about everything having its price. I'll ask you first, Julia. When does AMP start to look attractive?
Look, I think for financial companies, what you want to see is either strong performance and strong fees coming through. And look, if you don't get that, then there's almost a bit of a spiral down. You've seen it with fund managers when you see underperformance, but when you see a hit to reputation, and we've seen it probably most severely in a company like Blue Sky, that there does tend to be an ongoing effect in terms of how much money they can get in through the door. So it's about future growth. So I guess the market is starting to discount AMP and I guess some of the other banks and their wealth management businesses. But given that, the wealth management side of things is a much bigger portion of AMP's business and they're much more reliant on selling their own products, I guess the market's really focusing in on AMP. So look, I think it's a bit of a spiral when you get into these situations where you do see brand reputation being hit, especially for a financial company which either trades on its ability to perform or its reputation. So a hit to a reputation, I think, is quite a serious thing for a financial company, especially one that looks after people's money. It's all about that safety, security and credibility.
Just noting, market alert, LME nickel rallying 4%. We were just talking about nickel to 14,790 a ton. Call Peter Strackenbach. Yeah. But anyways, Julia, I know you've got CYBG in your sights today, one of the worst performers on the 200. I mean, the market clearly caught off guard by this provisioning that they announced pre-market open.
Absolutely. Look, this is a company where the outlook has been quite good and their balance sheet has been quite good as well. And I guess the market now just taking that latest news in and pricing that in. And of course, the latest news is not good news. It's about the payment protection insurance. And this is where over in the UK, this insurance was sold to things like credit cards, store credit cards, mortgages, anything that's classed as a loan. You can probably ensure that this product was sold. But the problem was that a lot of people were sold this without knowing. So there's a lot of court litigation, a lot of complaints coming through at the moment. And one of the things is that there's a deadline of August 2019 for these complaints to come up. So I guess because of that, with CYBG or Clydesdale seeing a lot of those complaints come through. The problem is that there is going to be a profit impact, so there'll be a charge of £202 million to its half-year numbers, and also it means that in terms of its Tier 1 ratio, which was at 12.4%, there'll be about a 100 basis point hit, and the company does try to stay within an operating CET1 of about 12 to 13%. Now, it isn't a problem because they do have a pretty fat buffer because they are planning to get IRB approval, which should bring down their capital needs and release some of their capital. But as a once-off, I think the market is pretty concerned given I guess the estimates that were already out there, and given the number of complaints that are coming to the fore here, even I think Clydesdale was saying they were quite surprised with the velocity of it, but it could be the deadlines and also the publicity over in the UK around this.
All right, Julia, thank you.
Thanks, Nadine.
Time to go.